For those that don't know me, my name's Larry Pruss. I'm the host of Tech Talks, and I work for a company called Strategic Resource Management, or SRM. We're a full-service advisory firm. We consult on a number of third-party vendor management, payments, core, emerging technologies, and pretty much anything else a bank or credit union might need help with. Our Tech Talk series really is an event where we discuss the intersection of traditional finance and emerging, potentially disruptive technologies. Frequently, we feature guests from the industry. Sometimes we present, and occasionally we just have an open conversation. This is one of those times where we will be presenting a topic, and I always enjoy that because I do like to talk. And it's one of my favorites. We're going to be talking today about digital assets, tokenized assets, and unified ledgers. We're not going to be spending a ton. Oh, sorry about that. We're not going to be spending a ton of time on digital assets like blockchain or anything. But what we will be talking about is digital ledger and kind of some traditional or uses more in the traditional banking setting. So that's what we're going to be covering today. Before we do that, I do want to, and if anyone else can just let people in lobby, I'd appreciate that. Before we go into the presentation, what I wanted to do was provide some notable industry updates. And it's been a busy couple of weeks in terms of the industry. So, last month we saw the launch of 11 spot Bitcoin ETFs, certainly cementing Bitcoin as an asset class that is not going away and will probably have impacts to the financial system for years to come. As expected later this year, we will see similar ETFs launch for ETH. And to give you an indication of just how successful those ETF launches have been, BlackRock's Bitcoin ETF holdings have already passed the $2 billion mark. The Bitcoin ETFs combined have around 22 billion in assets and could draw as much as 100 billion this year alone from retail and institutional investors, some analysts predict. There's also been an announcement that German banking giant DZ is going to pilot a crypto trading later this year, and many commercial and central banks are already experimenting with cross-border payments. In fact, earlier this week, the UAE initiated its first cross-border payment using the digital dirham, and that's the national currency of UAE and I think Morocco. Some other news, Vast Bank, one of the regional banks involved in offering crypto to its customers, in fact, it was the first, is under a consent order from the OCC and is exiting the crypto business. While not entirely related to crypto, at least some of the order appears to be tied to their custody of digital assets and expenditures on computers, IT, and other intangible assets. They hold about 2 million in crypto on behalf of their customers. So it's likely there's some additional stresses in terms of capitalization, liquidity, interest rate risk. So it's probably not all crypto, but they are exiting that business. We're also seeing tightening of banking as a service providers, so BaaS partners. Financial institutions including Blue Ridge Bank Shares, Cross River Bank, the First Northwest Bancorp have been forced by regulators, including the Office of the Comptroller of Currency, the Federal Deposit Insurance Corp, and to heighten oversight of their fintech partners and strengthen compliance. For example, on January 26th of this year, the OCC hit Blue Ridge with a second consent order. And while the FDIC published consent orders related to fintech partnerships formed by First and People's Bank and Trust and Company and Choice Financial Group. So, the BAS partners are drying up a bit, and I think that plays into this narrative that I'm going to be talking about here in a bit. I would say add to this the anticipated heightened enforcement involvement of the CFPB in larger fintechs. What I expect we're going to see is some of the larger technology players considering pursuing special purpose banking charters rather than maybe banking partners, right? So going with banking charters instead of banking partners. I mean, if you're going to be regulated like a bank, why not get a charter and get access to the Fed? On the CFPB getting involved in fintech, they have stated their plans to hire 75 employees this year. That includes attorneys, economists, and paralegals to expand their enforcement team. Thus, perhaps we'll see Apple or other large fintechs pursue their own charters rather than finding banking partners. Case in point, and this may not be necessarily the same, but could be. Fiserv recently applied for a special banking charter. It appears that charter would enable Fiserv to authorize, settle, and clear transactions for merchants, removing the need for a banking partner. It should be interesting to see if that might be related to some recent news that starting in February 15th, California's prepaid debit card program for unemployment and disability benefits will be handled by Fiserv's Money Network, replacing Bank of America. And then finally, I'm sure everyone saw the FOMC minutes, but yesterday at the FOMC meeting, the Fed, as expected, left the benchmark rates unchanged at 5.25, 5.5%. This was expected, while also making some big changes to their statements to reflect a more balanced outlook towards cuts versus hikes. One interesting change in their statement was the removal of language stating that the U.S. banking system is safe or sound and resilient. Perhaps this was a subtle reference to concerns about New York Community Bank and their stock plummeting 45% yesterday under concerns about their commercial real estate loans, which also is reigniting fears of another regional banking crisis. A New York Community Bank does have a connection to the digital asset space, in that it was the FI that acquired most of the failed Signature Bank last year during the banking crisis. And speaking of safe and sound banking, as of yesterday, there's a new OCC consent order and a $65 million penalty against City National Bank, finding that the bank engaged in unsafe and unsound practices, including a failure to establish effective risk management and internal controls. So that was my preview before getting into my presentation, but I thought I would cover some of the recent news. Any questions or comments on any of that, and then we'll get to the presentation.
Is that all you have, Larry?
I know it did seem like a lot. I'm like, I knew there were some things I wanted to cover, and I'm like, man, there's a lot on this. So I'm hoping to get through this presentation. But this was a last minute thing, and I'm like, I got a presentation I'd love to give, and I've got these things I want to talk about, so I'm just going to go for it. So with that, we're going to talk about digital assets, tokenized assets, and unified ledgers. Quick disclaimer, obviously, anytime we talk about digital stuff, I've got to say I'm not an investment advisor. Don't take any of this as investment advice. With that, so I think it's worth a quick review. And I know most of you are bankers, credit union executives, fintechs. Probably everybody understands how money moves, but I'm gonna review it anyway. It's even good for me sometimes. All right. So if I send a payment of $100 from me to you, any of you collectively, at the beginning of the transaction, my bank owes me $100 for my deposit monies. At the end of the transaction, your bank owes you $100. Could be a credit union, right? I'm going to use bank interchangeably. There is a transfer of liability, right? Because deposits are considered liabilities between my bank and your bank, operating across proprietary databases run by each bank. Those are what we call the cores. Each bank is its own island of data representing on its books and records, customers, and their deposits, or in the case of credit unions, members. Traditional payment systems require messaging between these islands of data and involve convoluted reconciliation settlement processes, leading to frictions and delays. Liability transfer is achieved by my bank sending a message to your bank that says, give you $100. However, your bank isn't going to take that transfer of liability unless they receive a matching asset, right? Thus, my bank sends also a message to Fedwire and asks the Fed to send some of my reserves that's sitting at the Fed to your bank reserves that's also sitting at the Fed, right? So there's a transfer of assets, or transfer of liabilities, or transfer of assets. The messaging that kind of allows the debits, credits to occur, that takes place at the speed of light. It's the settlement process that takes time. And that's dependent on Fedwire, which isn't real time. Now we're starting to see FedNow and other sorts of ways to speed up settlement processes. But in this case, traditionally Fed money is a common asset. And the reason for that is there's no liabilities associated with it. That's why it's used to settle between banks. Question is, could there be a better way? and that's what we're going to talk about today. I like reading stuff from the Bank for International Settlements. I think it's an early bellwether for what might be coming. They're the bank of all central banks, right? So they kind of coordinate central banks among central banks. And Augustine Carsons, who's the general manager for Bank for International Settlements. Oh, and sorry, I didn't advance the slides, guys. See if I can do that right. That would have been useful for you to have that slide. Anyway, Bank for International Settlements, Augustine Carsons said that what he wanted to do was lay the financial infrastructure for a modern financial system. The financial system is still full of transaction costs, compliance costs too. So one very important motivation is to reduce those frictions. So lay the infrastructure, reduce frictions in banking. We want to incorporate our solid foundation to incorporate new technologies. I wonder what new technologies he might be talking about. And facilitate the development of a future financial system, not today's financial system, facilitate development of a future financial system. And the other thing is to onboard more people, and they're looking for kind of underbanked. For instance, one of the main issues related to lack of sufficient inclusion is that transaction costs are very, very high, which all makes sense. International development in blockchain and instant settlement systems has certainly been significant. Some of the countries leading those efforts include, obviously, the Bank for International Settlements, which isn't a country, it's an organization. IMF's also an organization, that's International Monetary Authority, IMF. Singapore, China, Japan, Switzerland, UK, Israel, Brazil with PIX, India with UPI. They all are making big strides and appear to be potentially, in the case of India, they're actually looking at exporting their UPI throughout the world via partnership with Google. And that was news, I think, from last week. Brazil's PIX transactions, which isn't blockchain, but is instant payment settlement. Their transactions for the first quarter of 2023, which PIX is a big success in Brazil. The number of transactions they had in first quarter of 2023 totaled 8.1 billion. That was versus 4.2 billion credit cards and 3.8 billion debit card transactions. And that has just grown. So PIX is more popular than Visa or MasterCard, debit or credit, according to Bank for Brazil data. So, that's something to think about. Again, the world is changing in terms of financial systems. So talking about the BIS, what is their vision? Well, the world central banks, led by the Bank for BIS, are rethinking the monetary system designed with unified ledgers, tokenized money, and central bank digital currencies. Now, this isn't going to happen all at once. It isn't going to happen in every single country. Like any new technology, we're going to see some faster adoption than others. But we all know that at the end, technology tends to find a way and kind of win the race. The tokenization of money and assets have a lot of potential, but most initiatives to date have taken place in silos without access to central bank money and the foundation of trust it provides. So we've talked or heard a lot about stable coins in the past. That's certainly not central bank money. It may be backed by, say, US dollars, but that's a little bit different, right? A new type of financial market infrastructure called a unified ledger could capture the full benefits of tokenization by combining central bank money, tokenized deposits, and other tokenized assets on a programmable platform, potentially including stablecoins. A unified ledger would harness the programmability to enable arrangements currently not practical, like 24/7, 365 domestic and cross-border operations, thereby expanding the universe of possible economic outcomes. And again, sorry about not advancing the slides. I'm going to keep talking anyway. So today, money and other claims are recorded in separate databases. We talked about that earlier. They're called ledgers or cores. And they need to be connected to each other by third-party messaging systems, right? Like Swift and Nacha and those sorts of things. All transactions need to be reconciled separately, and clearing has to occur before transactions are settlement. That's why in the processing world, we talk about authorization and settlement, right? They're two different things. What the BIS is looking to do is combine trading, reconciliation, settlement all into one instant transaction. They called it an atomic transaction when transaction occurs instantly. Similarly, here in the US, several large banks, Citi, TD, Wells Fargo, and others, along with the New York Fed, along with MasterCard and SWIFT last year, they trialed a similar sort of solution called the Regulated Liability Network, RLN, which is basically a unified shared ledger platform. And I'll drop links for that when we get down to the end, as well as a really interesting video on Regulated Liability Network. A unified ledger would likely come in the form of a blockchain. Doesn't have to, but likely, which I'll describe later in the presentation, blockchain. And blockchain is really just a database that maintains a continuing growing list of ordered records. And blockchains can be permissioned and centralized or permissionless and decentralized. Some examples of what a unified ledger could enable beyond kind of expensive instant settlement are things like micropayments on the Internet of Things, eliminating escrows needed for real estate transactions. Those are just some quick examples. Okay, there we go. Now we advanced it. So we talked a little bit about this unified ledger. What is this? BIS envisions CBDCs, we've heard of this before, central bank digital currencies, so the digitization of existing central bank money, tokenized deposits, and other tokenized claims on financial and real world assets being brought together in a new type of financial market infrastructure called a unified ledger. You're in here, unified ledger, you're in here, regulated liability networks. They're really one and the same, shared ledger. This unified ledger works differently in that it is a single shared ledger in which two entities and a debit and credit are made simultaneously, settled atomically, as I said before. The result is that no control accounts are required, no transfers to other ledger books is on the shared ledger. The UL transforms the way the intermediaries interact to serve end users, allowing for sequences of financial transactions to be automated and seamlessly integrated. We'll talk about how they can be automated because the current financial system doesn't allow for automation today. The automation really can occur when you get the programmability of money, and programmability of money can happen through smart contracts and really can only happen on chain. So again, I'll talk about that here in a bit. Benefits are instant settlement, 24/7, 365, more secure, more efficient, eliminating settlement risk and allowing for programmability. And it's not just domestic, it's international as well. Some examples of what, oh, and I actually already said it, gave some examples before. So let me move to the next slide. So, you can't talk about a unified ledger without talking about blockchain. And so most of you are familiar, we've talked about blockchain in the past, but again, it's worth mentioning, blockchain is a shared digital ledger. Information's encrypted, it can be used for peer-to-peer, but it could be used in a banking setting as well, with third-party intermediaries potentially operating that shared ledger. Now for data sharing, and you can put things other than just assets or liabilities on a digital ledger. You could put all sorts of things on a digital ledger, whatever you want to tokenize. Most blockchains are decentralized and permissionless, but certainly not all of them. Really today, money and other claims are recorded in separate databases. So those are ledgers. Yeah, and I mentioned before, those need to be connected by third-party messaging systems like Swift and Noxia. So, a shared ledger would eliminate that. All right, so we talked about shared ledgers, we talked about blockchain. Now we have to introduce the concept of tokenization. Tokenization is a process of representing claims digitally on a programmable platform. Any items of value, such as money, stocks, bonds, even art could be represented with tokens that reflect those values. Tokens integrate the records of the underlying asset with rules and logic governing the transfer process for that asset. Tokenization could unlock new types of economic agreements or arrangements that frictions inherent in the current monetary system has made impractical. Okay, so we've heard talk before about digital assets, and I'm introducing the concept of tokenized assets or digital tokens. it's probably worth reviewing kind of the wide range of digital things that are out there, right? So people are familiar with cryptocurrencies, things like Bitcoin and Ethereum. These are digital assets. They differ from some of these other ones, which are digital tokens. The way to think about it is that digital assets are in themselves the value, whereas digital tokens represent something of value, if that makes sense. And we can talk about that a little bit more in the next slide. We are going to be talking about stable coins and tokenized deposits because that is where a lot of the research and efforts are being focused on today. And then you know, central bank digital currencies, a lot of development. In fact, I think there's like 190 central banks around the world working on those. We've got a couple trials, couple rollouts, not a lot of adoption around those. And I kind of wonder if we will continue to see adoption. I suspect what we'll ultimately land at is where central bank monies, digital central bank currencies are used in a wholesale format for settling between institutions or settling between other central banks. And then, tokenized deposits or stable coins are used to settle either interbank and or with customers, members, clients. All right, so isn't money already digital? Yes, it is. There are different ways of looking at or different versions of digital money. And so I'll start with central bank money, right? So central bank money is a liability of the central bank. It exists in two forms: reserves held by commercial banks and cash in circulation. Well, a liability of central bank, there's no liabilities associated with central bank money. And then you've got commercial bank money. Commercial bank money is a liability of the commercial bank in favor of the depositor. It is stored in accounts and is denominated in the form of digital money, one side of the risk-taking balance sheet. And then electronic money would be things like stored debit cards, PayPal. It's a liability of a regulated non-bank payment company. It is redeemable on demand, and at par value usually does not pay interest. So all of those three categories use sovereign money. So sovereign money is central bank or a country's money. It's currency. Liability of regulated institutions promised to pay a known entity on demand at par value, and it's an account-based representation on double entry bookkeeping. Right, that goes back to the stuff stored on debits and credits within the financial institution's core systems. The other type of digital money are things like public cryptocurrencies and stable coins, which also I'd throw in there tokenized deposits potentially. Public cryptocurrencies, so the regional Bitcoin and all of the derivatives are not liabilities. They are intangible assets traded on exchanges and peer-to-peer. So their value is what you believe their value is, but they are the value. There's no liabilities typically associated with those. Stable coins, on the other hand, seek to deliver the benefits of tokenization while removing volatility. So as we know, cryptocurrencies are very volatile. Stable coins are not so, because they tie their price to an underlying asset. So that could be gold, it could be the dollar, it could be anything else. And so what they do is they're fully collateralized in that underlying asset. So any price movement in that underlying asset is reflected in the value of the stable coin. So if you've got USDC, which is Circle's stable coin, which is underlying assets are cash or near cash equivalents, it doesn't fluctuate a lot, right? It's not meant to fluctuate a lot, which when you eliminate that fluctuation, you can suddenly use that for things like payment and settlement, because you don't have to worry about price movement in that underlying asset. Institution may or may not be regulated, right? So we can have private stablecoin issuers, which aren't regulated. They're increasingly being brought into the regulatory framework, but certainly not regulated the way that the banks are. Uncertain whether or not stable coins. There's certainly all stable coins are redeemable on demand at par value. I mean, we had Terra Luna, the debacle of that, where like, that was an algorithmic stable coin, and certainly they weren't able to redeem at par. Most of the stable coins, and I think most of the, at least the recognized ones today, are very stable, appear to be able to be fully redeemable at par. The problem with getting adoption is, now you're saying, might be thinking, well, why would a merchant not want to settle with that? Because it's settling outside the traditional Visa MasterCard rails, and it wouldn't cost a merchant 300 basis points of merchant fees and blah, blah, blah. Well, the reason is because even if I believe the stable coin is essentially a bearer instrument and is backed by US dollars redeemable par on full, until there's a law that says, hey, if you don't hold up that end of your commitment, stablecoin issuer, and something goes south, if there's no way for me to sue you or for someone to go to jail as a merchant, probably not going to be real comfortable using that payment mechanism until that happens. We were expecting legislation this year to happen around stablecoins. We were hoping even last year. This year's obviously election year. Congress doesn't really have its act together, so I doubt we'll see anything this year, probably 2025. The thing to note about cryptocurrencies and stablecoins, these are non-sovereign currencies, right? With the exception that you might have dollars associated with stablecoins. They're typically non-liability instruments, and they typically come via unregulated issuers. When I say non-liability instruments, even stable coins, if they're fully collateralized, right, there's no liability associated with it. And then they are token-based representations of some sort of underlying value, or in the case of cryptocurrency, it is the value. And they also are on chain. So I think that's a nice way of kind of thinking about that. Yes, most money today is digital. However, what differs is, one, who holds a liability, and is it recorded on the standard ledger via double entry account entry, right? Double entry accounting, or is it on a platform like a core, as opposed to a shared unified ledger where those transactions are recorded basically in one transaction by atomic settlement. Now, when we talk about digital assets, and securing these things, they're secured by cryptography. I'm not going to spend a lot of time on that, but this is something that's going to become more and more important in traditional finance as we find ways of moving money from digital wallets to financial institutions and back, and between financial institutions. There's got to be a secure way of doing that. When you're leveraging a shared ledger, it is a very secured way of doing it, and locking those assets down, whether it's into a private wallet or financial institution, that can be very, very secure using cryptography. So, we've heard of failures in the past. Most of those are human failures where people are tricked into giving up their keys and those sorts of things. But just know that blockchain as a technology and the cryptography that surrounds it is very secure. So as we see things progress, and we are over the last however many years, like last year, I think I said in the beginning of the year that it would be the year of tokenization. I think we'll see a little bit of that this upcoming year. I think we'll start to see AI even work its way into kind of the digital asset space and blockchain space, in that it would be a useful way of helping determine or run smart contracts. But in terms of what's likely to win, at least in the short middle term, of being a kind of a digital money or digital representation of money that everyday people could use or financial institutions could use, I think it comes down to a race between stablecoins and tokenized deposits. And they sound similar, and they are similar, but there are some subtle differences and important ones. Stablecoins are privately issued, whereas tokenized deposits are bank issued. They both allow for the direct payment between businesses, individuals, merchants, and others over blockchains. There's a difference. Stablecoins typically being public permission blockchains. The benefit of that is, That doesn't have to be tied to any particular institution and can facilitate cross-border. In the case of tokenized deposits, you want a private permission blockchain. One of that has to do with visibility into money movement, right? So like if I'm moving $20,000 to another bank or making a payment to someone, I don't necessarily want everyone in the world to be able to see that. Blockchains are inherently fairly transparent, unless it's a private permissioned one. And that's one of the differentiators between tokenized deposits and stable coins. Stable coins should be, and probably by law will be required to be fully collateralized. So if you ever heard of full reserve banking, that's essentially what it is. It does have some problems in that it ties up liquidity in the system and doesn't allow for fractional reserve banking. So full reserve banking isn't necessarily what the Fed would like, right? Because we lend on a reserve basis and get money into the economy and help facilitate capital formation and business growth and things like that. So stable coins could potentially stymie some of that. Tokenized deposits, however, may or may not be fully collateralized. I think it would be initially fully collateralized, but then when people got comfortable with the way those things ran, they could probably do it on a fractional reserve basis and have be partially collateralized. One big benefit of tokenized deposits is if it fell within the existing banking structure, they could potentially be backed by deposit insurance. And I apologize yet again. I'm working off two screens here, so one was not automatically moving ahead. But what I'll do is I'll send this out afterwards to everyone, just so you have the slides. I've obviously been talking through the slides or to the slides, but we'll move ahead to what is a smart contract? Because one of the other benefits of whether it be tokenized deposits or stable coins or just getting things on a shared ledger is the ability to basically make money programmable and create self-executing contracts. So you kind of write the code as an if then else. So it could be if the customer pays their mortgage in full, then we release a paper that says they paid their mortgage in full, and we tell the deed company to release the deed to them, something along those lines. So when the rules are met, the contract is executed, it's on the blockchain. It doesn't really require any sort of human interaction, which is nice because once you've tested it, once you've vetted and just let it run, that automation simplifies the process and ensures speed and accuracy, right? Because humans aren't involved. Right now, that's not a legal contract. It's more code. I think we'll eventually see some court rulings that might define it as a legal contract. I think it would be ideal to be a legal contract, particularly if we're using it in a banking construct. All right, this is a busy slide, but so what are some of these use cases of this shared ledger, both retail and wholesale? So if you look in the bottom of this chart, are existing use cases. You look at the top, are new use cases. To the left are existing retail use cases. To the right are existing wholesale use cases. So let's start on the lower left. Existing retail use cases certainly could facilitate better cross-border payments, more secure e-commerce payments with instant settlement, enhanced receipt of government aid and social payments. I mean, these are all things that are being worked on. They're even being worked on by groups like the U.S. Faster Payments Council. They're looking at these things. Some existing wholesale use cases would be better intercompany flows, better cross-border payments, enhanced PVP and DVP for FX and securities settlement, automation of trade payments. So those are all existing use cases. Now, the new use cases, which are at the top of that chart, are what's really interesting. So let's start with retail first. Those would be things like micropayments. So being able to effectively and efficiently and cost effectively make very small payments. It could be for the gig economy. Fractional reserve ownership models, right? Where you have an asset where you might not normally be able to afford it, but you can fractionalize it and a number of people can afford it. I mentioned gig economy payments, broader access to digital payments, digital identity. That's an important one that we're starting to see creep into traditional finance. From a wholesale standpoint, it could be payments around Internet of Things, programmable payments I mentioned before through smart contracts, digital autonomous corporations or DAOs, for those of you who are familiar with that, decentralized finance, and again, kind of real-time settlement, 24/7, 365. So those are the use cases. Where the industry is today, I would say it's not waiting for either U.S. regulations or global regulations. Global regulations are actually already happening. Most companies aren't waiting, certainly, for stablecoin legislation to occur, like the PayPal's of the world. PayPal launched PYUSD, a stablecoin that you can use to pay at PayPal merchants, or you can use it to send money to people as P2P. You can use it to transfer between Venmo and PayPal. Like, why did they not wait for stablecoin legislation? Well, because they know what it's going to look like. We can look to the rest of the world to see what legislation has been rolled out, and it is fully reserved backing. It is full redemption in a timely manner. It requires audits and transparency, and of course, the standard Know Your Customer AML and Bank Secrecy Act stuff. Mentioned PayPal launching the stablecoin. Circle recently partnered with Visa to bring stablecoins to businesses. Citi recently launched tokenized services, a tokenized deposit for trade finance and cash management. I would say, like, from a stablecoin standpoint, it's interesting because last year, and this has been similar for like the last 2 years, the amount of stablecoin settlement that has occurred around the world is on right around 6 to 7 trillion, which is just about where the international settlement for Visa is. So you think Visa, as large as that network is, and all of the transactions and money that they settled about $6-7 trillion of value. Stable coins are right there with them. So, like, this is not something that's going to be in the future. This is stuff that's happening today. And then, as I mentioned before, several blockchains and a regulated liability network, they were tested last year by the largest banks. And there's a couple platforms. I mean, it was really platform agnostic, but the platforms that they kind of looked at were Hyperledger, R2, and Digital Asset, for those of you that are familiar with that technology. And then messaging would likely continue to be via the ISO 222 standard. So that's a messaging standard that everyone's supposed to get up to speed on. Once we do get a bill passed in Congress, I think we'll start to see merchants accepting tokenized deposits and or stable coins once they can be ensured those tokens are fully reserved and redeemable. This could certainly lower transaction processing costs. As an example, PayPal could be used today to pay merchants or send funds. Fortunately, for the existing payment providers, MasterCard and Visa, this adoption won't happen overnight, but it's like that death by 1,000 paper cuts. And we're continuing to see adoption. We're continuing to see creativity and innovation in this space. And then, end of this year, beginning of next year, we will start to see the implementation of open banking standards, which I think is going to be an enabling factor of a lot of these, because you're going to see fintech starting to leverage banking data and offering services that the banks might not have been as effective in offering. So I'll get my parting thoughts out here, and then we'll pause for some questions, and I'll also share those links for the regulated liability network. But I think banking is going to move to fully tokenized deposits in other liabilities and assets, moving over a unified permissioned ledger. I think it's going to be led by the largest banks around the world, because they're already seriously investigating this unified ledger platform. There's probably half a dozen last year with the regulated liability network. I think that's expanded. So there's a fair number of banks kind of forming a consortium. If they end up coming up with that as a solution, I think it's got real ramifications for the core providers, right? Because core providers, if you got a shared ledger, you don't need cores. You could still have little add-ons, but that could be a problem. And in addition, if you get this consortium that offers a shared ledger platform for transfer of money, assets, liabilities, they could take that and then essentially bucket it and sell it to community banks and credit unions, the same way that that consortium of similar banks put together, the real-time payments through clearinghouse or early warning system, Zelle, right? They're known for doing that. So I kind of expect that might be the rollout approach. The thing with the regulated liability network, as opposed to stable coins or even cryptocurrency, the approach works within the existing legal, regulatory, and two-tiered banking system. Like that's a big deal. Could also be the model for a truly interconnected international payment system, which is what the BIS is looking to do. Moving to unified ledgers or similarly related regulated liability network could have significant impacts on, and I said this, on banks and credit unions continue to exist in the US, mostly because unless they're part of that big bank consortium, the smaller banks and credit unions are going to experience drawbacks of their current banking platforms, which are high costs, slow settlement, reconciliation challenges, settlement and counterparty risks, fraud, and lack of programmability. So they can be at a disadvantage, or they'll have to buy it from a big bank. Furthermore, the existing platforms, disparate ledgers, i.e. cores, might no longer be needed as a future model will likely be a shared ledger system or network of networks. I mean, we've seen cores go to cloud. I think we will see cores go to blockchain. And what that looks like in the future, who knows? I know the big processors have concerns about this. I'm sure they're not resting on their laurels and trying to figure ways to continue to be involved. But that's significant change to significant infrastructure at financial institutions. And then I'll end with, this could be either years away or it could come faster than anyone expects. I was talking with one of my colleagues earlier today, and I'd put it at like earliest 5 years, more than likely 10 years out. But for some of us, we're still going to be in our careers 10 years out. And if you think a core conversion is a headache, imagine going to a shared unified ledger. But that might just be the way the world is going. So that's the presentation.